Hey, what's going on, everybody? Apologies on the delay for the class today. Um, I had a issue that I had to take care of, so but we're still gonna get into it, and obviously everything's gonna be recorded as usual. So you know, we should be good to go. So just wait for a couple other people to hop on. Um, Again, this will be recorded. Um, Appreciate you, Tony, and your time. So I know Tony. Tony's been on every class, so I know he's gonna get something out of this. So um, today we're gonna talk about liquidity and market structure. So I'm pulling some stuff up, and some of this will be. I mean, the market structure stuff will be a review. I think everybody, if you've been trading longer than a, I don't know, like a 6 months, then you probably understand the concept of market structure. But it's very important to understand how market structure works, because it's one of the reasons that we're going to be able to identify liquidity in the market. Oops. So get started in a second. Do this. Let me clear out all of this. Hopefully this will be easier to watch and play back, because you'll be able to kind of fast forward exactly to where I start talking. But give it a couple more minutes and we'll hop on this. Market structure. So I just want to get a good picture up of market structure. We'll talk about it. I actually don't have this drawn out in my presentation. I'll go on later on today. So so I just need to have a good picture that I can pull from. Okay, cool. Let's zoom in. All right. So what we're gonna talk about today is gonna be. Hey Jameson. Hey Jameson, where are you based out of? Actually, you don't have to message that in the chat right now. I'm kind of curious. I know Tony's been in this chat for a while, but kind of curious to where you're based out of. So feel free to message me in Telegram. Yeah. So anyway, so let's talk about. So the things we're going to talk about today are going to be market structure and liquidities. I'm going to start with market structure first, because this is going to be the most important thing that you're going to talk about. Well, it's going to be one of the most important things when it comes to identifying liquidity. So, um, so when it comes to a market structure, we really have two or three different types of market states, right? This is very, very basic, very general stuff, right? So we can either be in an uptrend, a downtrend, or we can be in a ranging market or a consolidation market. Uh, so when we talk about uptrends, I'm sorry, let's start with downtrends, right? It's going to be comprised of two things, right? You're going to have a lower low and a lower high, meaning that this low is going to be lower than whatever low comes before this. Um, and this high is going to be lower than the previous high. So in this case, right, we have a low that's lower than this previous low, and a high that is lower than that previous high. So downtrend is going to be pros of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, right? So it's very, very like basic stuff. If we're talking about an uptrend, right, it's going to be the opposite. Um, Obviously, it's going to be comprised of higher highs and higher lows, right? Higher highs, higher lows, higher highs, higher lows. If, and this is not a trick question, right? If you think the market is going to go down, right? Where would you want to where would you want to enter in on a downtrend? Like ideally, not a trick question. Like if you could get in on maybe 1 or 2 points of this downtrend, where would you want to get in on, to maximize your profits? I'm gonna open this up to the chat and just it's real quick, just so people are with me today. This is like the interactive portion of today. So if you had to pick one spot to get in or 1 or 2 spots to get in on these trades, where would you want to get in if you thought the market was gonna go down? At the lower low points or the lower high points? Man, y'all are asleep today. Well, exactly, the previous highs. Boom. If I'm in a downtrend, I would want to get into a trade at the previous highs. So, with that being said, most of the time I'm going to enter into a position, right, at this lower high point, and I probably will throw my stop loss, somewhere above this high, right? My buy stop will go somewhere over this high. It would be nice to get into a swing point in the reversal, 100%. But if you can't catch the reversal, right, and you're just trying to follow the trend, for instance, you would definitely want to get in on the lower high points or the previous highs and ride it down. So that means again, your entry would be somewhere in here, right? Ideally, and you would probably place your stop loss over the high. So if we talk about downtrends, again, last interactive question I'm gonna have, but we talk about higher highs and higher lows. Where would you want to get in on an uptrend? Like ideally on an uptrend. I know y'all are looking at the screen like, okay, this is very, very basic, but you know, it's gonna build what we're gonna talk about today. The one downside to these live chats or these live things that I'm doing on YouTube, since it's not a YouTube channel, I can't have people just come off mute and just give me the answer. So it's like I gotta wait for it to pop up in the chat. Okay, so exactly. So the green ports, the new support, right? Or in this case, the higher low points, right? And I don't have this labeled, right? Because I just literally pulled this example from the internet. But these would be you'd want to get in on the higher low points. right? That's the most ideal area that you'd want to buy in to maximize your profit each time and each swing. So remember that, because we're going to come back to that today, right? So again, your entry would probably be somewhere around the new support levels, right? Or yeah, but right around those areas, and your stop loss would probably go somewhere underneath either, a low or a previous low, right? So your stop loss in the form of a sell stop would probably go somewhere underneath those those lows. So remember that as we kind of talk about today's presentation or today's like um, main thing, because it's gonna drive back to the idea of liquidity. And again, if you think about the first couple weeks when we're talking about the forex markets, um, we've talked more about the idea of the sessions, the power of three, right? Accumulation, manipulation, distribution. So that's basically talking about the how, like the mechanics of the market. Today, again, we'll talk about like where the market's going to move in terms of liquidity, right? And so, give me 1 second, and I'll pull these things up. So that's And let me know if that, I mean, it's a very basic idea in trading. But again, if this is your first time being exposed to day trading and way, shape, or form, let me know. I can kind of break it down a little bit easier. But you hear that term like buy low and sell high, right? Or like the idea of the markets, you want to, if you're gonna get into a trend, you want to buy in at the lowest possible point, and you want to sell at the highest possible point, right? Um, and that's all the idea of buying in a market structure is. And so we use this idea of market structure to kind of give us an idea of where the market's going to be. It's never that simple in real life, right? Like, and if you traded for more than a month, you're going to know that like it's never that simple as getting in at the low point, because a lot of times you won't know where the low is going to be formed or an uptrend, or the high is going to be formed at an uptrend. So, what I want to talk about today, before we can even really talk about the idea of liquidity, we have to kind of talk about the idea of, well, I guess I'll skip it for today. I'll come back to it. Let me come here, share my screen here. Yeah, this is a real class. This is not like a YouTube video presentation. So, I apologize on this. So, let's talk about liquidity, right? What is liquidity? So simply put, liquidity is going to be money in the market in the form of pending orders or stops. Liquidity is going to come in two forms. You're going to have buy side liquidity, which you might hear me refer to that as, you might see it on my chart as BSL. You might see it as buy stops, right? Or I might just say buy side liquidity, right? So you have buy side liquidity and sell stops, or sell side liquidity, right? Again, you might see me on my charts put SSL. You might see me say sell side. And so basically, these are either going to be orders in the market where the uh, the market is going to basically um, the market's basically going to move between both of these liquidity pools in the form of buy side and sell side liquidity. Sorry about that, guys. Okay, so again, so the idea of liquidity is going to be like one of two things. It's going to be either in form of buy side liquidity or sell side liquidity, right? And so when we start to put all these things together conceptually, next week we'll talk about it's a conceptual lesson, but it's the idea of the algorithm and the interbank price delivery algorithm. And so basically, I won't touch on it a lot today, but essentially the algorithm is designed to facilitate trades between buy side and sell side liquidity pools. And so again, we'll talk about more about what that means, but next week it's more of a conceptual lesson. So when we talk about this idea of liquidity, market liquidity is going to be found in three main places, right? You're going to have previous highs, previous lows, gaps or voids, and imbalances. And so we'll talk about all three of these situations today. And really, the homework for today is going to be being able to kind of identify liquidity on these points. So when we talk about liquidity in the market, right, you're either going to find them at old market highs and old market lows. So again, I want you guys to go back to that idea that we just talked about a few minutes ago. And so you might hear me refer to like retail traders throughout this present or like throughout the course, right? Or the mentorship, right? And so again, a retail trader is really going to be anybody that thinks the way that we do in terms of like technical analysis or um, just being able to kind of like draw out stuff in your charts, right? So when you think about retail traders, again, if we go back to that example of the uptrend and downtrend, right? Where are you going to put your entry at on an uptrend? We just said it. We said it's going to be at higher low points. And so if I zoom in here, so you guys can see a little bit bigger, right? So again, when we talked about uptrends, the idea of an uptrend is to buy in at the lowest possible point, right? These higher low points or these support areas, as they were kind of referred to on the other side, right? So that means your stop loss is going to be right underneath those. On the opposite end, a downtrend is going to have your lower highs, lower high points is the points you're going to want to enter in on, right? And so your entries are going to be right there, and your stop losses are probably going to be right above it. So when you start to think about the idea of a market structure, right, or the idea of where we're going to find old liquidity, you're going to find these liquidity points under old highs on an uptrend or old highs on a downtrend or old lows on an uptrend. So the market is going to be you're going to see these um, you're not going to be able to see them physically on your chart, but you're going to be able to see that the market will run back to these levels because there's money there in the form of buy stops and sell stops. Basically, your stop losses are that are your buy in orders, your buyout orders, or your sell in orders, or your sell out orders. And so, if you look at examples of this on charts, and we'll do that in a second, you'll see, especially when you trade Forex or Nasdaq or any of these markets, you'll see the market run for old highs and old lows repeatedly, right? Because there's money that's sitting there on those charts. The second area that we'll find liquidity is going to be old gaps and void and liquidity voids. And so basically what a gap is, anytime you see it on the chart, whether it be a volume imbalance or a fair value gap or an actual physical gap on the chart, which is a gap between two candlesticks, basically gaps on the chart represent liquidity voids, right? And they're going to be areas where trades cannot be facilitated. And so this means that there are active orders in these gaps that need to be fulfilled in order for the market to have what's called a balanced price range. And a balanced price range is just a area where there's buying and selling action, right? Prices being distributed between buyers and sellers. Gaps are going to be found most commonly at the beginning of the week, beginning of trading sessions, or during news releases. So you might see in Forex, gaps don't happen too often, which is the cool thing about Forex. If you're trading the currency futures market, then you're going to see them a little bit more, like actual gaps, but fair value gaps and liquidity. I'm sorry, liquidity voids and actual gaps, fair value gaps. You're going to see these pretty often. So we talk about the idea, as I zoom in, of an actual gap on the charts. If you look in, you can see it. There's an actual gap between these two candlesticks, right? between that, um, this black candle is an up candle or green. It would be like a traditional green candle on a normal chart. So that's just saying price closed, opened up here, and then went higher, right? And so um, you can see that there's an actual physical gap between these charts. Also, the same thing here, right? If you look between these two candlesticks, you see a actual gap between the where price closed on one candle and where it opened up the next one, right? So we're going to look at these, we're going to revisit these a lot when we're actually trading. And these are going to give us an idea of where the liquidity is at. The third kind of liquidity that we'll talk about or how to is the idea of an imbalance, right? And so when we talk about an imbalance is going to be any area on the chart where trends in one or more one direction without any sort of counter. An imbalance can really be a single candle or multiple candles, right? Um, and I'll show you an example in a second. You can either have bullish imbalances or bearish imbalances, right? And so we can really anticipate price that at some point in time will revisit these areas. And so what do I mean by bullish imbalance? So if we zoom in on this actual chart right here, you see this one candlestick that just shot straight up. This will be considered an imbalance, right? It just price is trending in one direction, even if it's just for a candle. In this case, there are multiple candles. So this would be a series of bullish imbalances, right? You can see right here, this is what I referred to earlier as a balanced price range, meaning it's basically consolidation, prices trading back and forth, right? And this would be an example of a bearish imbalance, right? So you see a series of candles trending in one direction without any sort of counter back into that, on the bullish side. So just basically a trend, I guess is the easiest way you could say it, whether that trend is one candle or multiple candles. So you have bullish imbalances, balanced price ranges, and bearish imbalances. So oops. The last thing that I want to talk about when it comes to liquidity is this idea of a fair value gap. And you're going to see me reference these a lot, like a lot on the charts, whether I'm actually trading for entries or I'm trading just to kind of get a better overall sense of like where the market's going. And so what is a fair value gap? So a fair value gap is technically a type of imbalance. A fair value gap is defined when there are inefficiencies or imbalances in the market. And these imbalances are simply suggest that buying and selling pressure are not equal. Specifically, when we talk about fair value gaps, it's going to be a three candle play from the high of the candle prior to an imbalance to the low of the candle directly after the imbalance. And I'll show you again what an example is uh, on the next slide. When we talk about fair value gaps, they can either be what's known as a BISI or a SIBI. A BISI can be a buy side imbalance, sell side inefficiency. Because all this is a fancy word of saying there's too many buyers, not enough sellers. And a CIVI is going to be a sell side imbalance, buy side inefficiency, right? And so that just means there's too many sellers and not enough buyers, just the opposite. A BISI, too many buyers, not enough sellers. In a BISI, there's going to be sell side liquidity that needs to be matched in order for price to be efficiently delivered. In a SIBI, there's going to be buy side liquidity that needs to be matched for price to be efficiently delivered. And so the easiest way to think about this is, well, I'll show you guys in a second, is the pain example. But so just to kind of give you an example of what I'm talking about. So a fair value gap, again, is going to be a three candle play between the wick of the top candle on a BISI. If we're talking about an uptrend specifically, it's going to be the wick on the first candle through the body of the imbalance to the wick of the third candle. So it's a three candle play. So that high, this candle to that low. So this gap in between here is known as a fair value gap, In this case, it's a BISI, a buy side imbalance, sell side inefficiency. Um, and notice how the one thing I want everybody to pay attention to and notice when they watch this is how price trades back into these old fair value gaps, right? This has a lot to do with kind of like the process of what's going on. So when I teach you guys something, it's not going to necessarily just be like a candle pattern, right? There's going to be a thought process behind it because every time I take a trade, every time I look at the markets, I am kind of like using an analysis of like, I'm basically running through a thought process of like what this gap should mean in the grand scheme of things, um, in terms of the bias that I'm building for the market or the trade that I'm in, right? I'm not just trading patterns for pattern's sake. So when you think about a BISI, right? In this case, this is a BISI, a buy side imbalance, sell side inefficiency. This means there's too many buyers and not enough sellers. So what happens in this particular candle is that price moved up so quickly that inside of this gap, there is sellers who have not had the opportunity to have their order matched into the market, right? And so when you think about the market, all we're doing when we trade is we're playing matchmaker. And I'll talk about the idea of the algorithm next. But the market is consistently trying to match the buy orders that it receives in the market with the sell orders, right? It's just matching buyers and sellers. And so when you have an imbalance like this, right, where price just shoots straight up, there's buyers getting kicked into the market, right? Their orders are fulfilled, but there's sellers inside of this gap that are not necessarily being there, getting their orders filled. And so what price has to do is it runs back into these zones, um, to match orders that have been fulfilled. So like those buy stops or sell stops, those pending orders, right? Those are getting hit when the market runs back into these zones. So a lot of times the fair value gap can be a very, very, very important tool because what you can see here is a lot of times it'll run back into these things, and once it does, it'll kind of reject and keep going with the trend. The opposite is true for a civvy, right? So a sell side imbalance, buy side inefficiency. And here's an example. Again, it's a 3 candle play from the low of the first candle to the high of the third one. And so when we look and we watch, again, you can see how the market runs back into it and it rejects. And so what a civvy means is, again, it's just the opposite. So it's too many sellers, sell side imbalance, right? A buy side inefficiency, not enough buyers. Too many sellers, not enough buyers. So what I want you guys to think is that inside of this gap, there is buyers that have not had their orders matched. And so the market, in order to deliver a balanced price range or an efficiently delivered market, the market has to run into this and reject. And so when we see this, again, it's a sign that the market is probably going to continue to go lower. One, but two, it's kind of like the mechanical process of what's going on. So when, for me at least, the markets become less scary when you realize that they're a machine. And so to kind of like cement what's going on here in your guys' heads, I want to pull up this example of the paint example because I think this is like a very good example of how the markets um, deliver price, right? So let me pull this up, and I'm gonna come back here. But this is just it's the most relatable thing I can think of when it comes to how the markets deliver price. So I'm gonna turn the sound off of it. So if anybody has ever had the experience of painting a wall, right? Most people paint walls in their house or their apartment, or they painted it like, or know somebody who has, right? It's a very common thing, right? And so when you think about the idea of painting a wall, right? There's a couple things that happen when you paint a wall. So I'm gonna uh, pause this as we go up. So when you think about the idea of painting a wall, what happens, right? So you stroke up with the you stroke up with the roller or the paintbrush or whatever, and what happens is a lot of times you have these paint pockets, right? Like if you can see right here, there's paint pockets that are left in the, in the paint. And what happens, right? You can't just roll over it once. You have to roll back down over it again, right? And so it doesn't matter if you roll up or you roll down, like the first time you roll through, you're going to have these little paint pockets, right? Or these areas where the brush doesn't kind of fill in all of the paint. And that's the basically the same idea as what a fair value gap is, right? So when you go back to, I guess I gotta go back on to the deck. But when you think about the idea of a fair value gap, this imbalance, right, is basically like a paintbrush. Price is being painted up higher, but it's leaving these little paint pockets, right? Every time it does, it doesn't matter if it's a busy or a sippy. There's these little paint pockets of buyers and sellers that need to get their orders matched. In a Bissy's case, we had strong buying action. That's our like paintbrush up, but inside of the paint, right? There's going to be little pockets of sellers that have not had their orders efficiently delivered, right? So you have to roll back over it again to fill it in, right? And how do you roll back over? By filling it in, you drop back into the fair value gap, right? So same thing with the Civi. Once that fair value gap is plotted, um, you've had that initial paint stroke down, but there's little paint pockets of buyers, right? That need their price efficiently delivered. And so they need to run back in there again. And that's kind of like another paintbrush over the initial brush with that candle going in there. So let me know if that makes sense. Um, okay, so I'm going back to questions. So Jameson says, questions. The fair value gap Sibi, the first candle, even if it has a gap, is not considered a fair value gap. I don't know what you mean by that. The first candle, even if it has a gap, is not considered a fair value gap. Uh, it takes three candles in a row. Yeah, so it takes three candles in a row. So like going back to this example that I have here, uh, oops, right. So there's actually two fair value gaps in this picture or in this side, two civvies. Um, the first one alone is not the gap, right? It takes three candles to play it out. So it's a three candle play. So this box, it's drawn out in time, but what I'm really trying to capture here is this high or this low to that high. And so this zone would be considered the fair value gap. It doesn't matter, like I drew it out in time, but this zone from this high to this low would be considered a fair value gap. There's also another one here. It doesn't matter about the candle. It just matters about the zone and the direction. So see how we have this low to that high of that candle. There's not really a wick on it, but that high. This would be another fair value gap right there, right? The color of the candles or the direction of the candles is the only thing that matters, right? It doesn't necessarily matter what the sequence of the three candles are. So this will be a civvy, even though there's a black candle right there. Same thing as that. It's literally the zone. If you look between these candles, there's no gap, right? So if you look at the low of that candle and the high of that candle, there is no gap. So that's not a fair value gap. There'd be another one right there from that low to that high. So I want you guys to kind of visually start seeing that and then watch how the market drives back into it. It might tap into it like that. Like if you look in, it might tap into that zone like that. Or it could be a very deep retracement where it goes up higher and fills the entire gap in. Um, when I'm actually trading, I love to see the ones that don't fill in because it means that the price is strongly bullish or strongly bearish. They start to fill in, there's rules to it, and we'll kind of talk about those over time. But the ones that tap and go, those are the best ones. Um, Yep. So both are fair value gaps. Specifically, both are SIBIs, meaning there's sell side imbalance, buy side inefficiency. It's too many sellers, not enough buyers. And that's why the market rises back into it to fill it and mitigate it and goes back down. But yeah, only one of them has been like kind of mitigated or like has had price go back into it. Yep. So hopefully that pain analogy made sense. Um, it makes sense. I think it's like the easiest thing to kind of like that's what really kind of got my head thinking about fair value gaps and how to see it. And so whenever I give you guys something, it's never just going to be trading a pattern for pattern's sake because there's so much of trading that's situational, right? And there's going to be times where these patterns fail, and there's going to be times where I'm trading and I say I want this pattern to fail, right? And so it's never just looking at these things and saying, "Oh, this is it hit this is going to keep going down." Everything is situational, and it's going to be depending on the overarching bias that we're going to have for the trade. So, but again, if you need to know the fundamentals first, and then we can get messy. So when we talk about actual trading, yeah, we actually talk about actually seeing some of these things on charts. I'm going to pull up a lot of examples for you guys, but I need you guys first to understand what these look like. Um, and the last thing we'll talk about today is going to be like the idea. Stop my screen. So again, you're gonna see me talk about these a lot. So if you ever watch the weekend calls, you're gonna see me draw these out very quickly, like very uh, rapidly. And so just to give you an example, this is Nasdaq. Well, this is a forex mentorship, so let me stick with forex for now. So when we talk about fair value gaps, right? Um, again, we're talking about a BISI, right? um, a BIST is going to be measured from the low of a candle to the high of the candle. So if I zoom in, oh shoot, if I zoom in on a candle, you can see, and again, it probably doesn't help that my candles are white, but the high end of that candle, that wick, is right there, and the low end is right there. So all I'm doing is drawing a box. Get rid of this one, do it again. From this high to this high. And notice how price draws when prices draws that box. When I draw that box, kind of measuring the gap, price trades back into it and then rejects away, right, on a BISI. So we can use these. So when we see these gaps over time, we can see how the market reacts when it hits these levels, right? See how price consolidates right at the midpoint of that gap and then breaks through. Here's an example of a SIBI, so a sell side imbalance, buy side inefficiency. I usually try to make my BISIs green and my SIBIs red, just because it gives me something visual to see. Notice how price traded back into that range and then fell apart. Same thing with, get rid of this SIBI here. I'm gonna clear this. So from this low to that high would be a SIBI. Again, remember the color of the candles does not matter. It just matters the direction of the overall market, right? So this case is a SIBI, right? This is our imbalance. It's a sell side imbalance, buy side inefficiency, meaning too many sellers, not enough buyers. And so again, what I want you guys to think of when you see these gaps is like little inside of these gaps, there's going to be little paint pockets of buyers, right? Who need to get their orders matched. Right. And so what does the market do? It has to run back in here and grab those buyers before it can it can continue moving on. Because the point of trading, right? The point of this whole thing is to have an efficiently balanced market, and we'll talk about the algorithm in a second. But the point of this is to efficiently match buyers and sellers, so that when buyers come into the market, sellers can get their orders matched, and sellers come into the market, buyers can get their orders matched. And so most of the time they're going to do that with pending orders. They're not the most of the money in the markets, whether it's forex or stocks or futures, right? Like these markets are going to be driven primarily by big banks and hedge funds. They're not like us sitting around waiting to hit buy and sell when we think we have our signal. They're usually going to be driven by like pending orders. So a bank might have, you know, a trigger or a stop loss either to get into a trade or out of a trade here, and they might have $1 billion or $10 billion sitting at this low, and the market's gonna eventually run to that level and get it kicked in. But most traders who work for big banks and hedge funds are not sitting around waiting to hit the button buy or sell. So the whole point of this market is to efficiently deliver their orders, but really any order that comes into the market. So when we talk about again civvies, oops, we talk about civvies. Again, I want you to think this idea that this is a sell side imbalance, buy side inefficiency. There's so many sellers. There's so much selling action that the buyers did not have a chance to get their orders matched up. So price kind of gives them the opportunity to get matched in by coming back in that zone and then rejecting and then continuing to move down, right? And you see this play out over and over and over again. The other thing that we talked about is the idea of buy side and sell side liquidity. So over every high, I want you guys to start seeing buy side liquidity. And over every low, I want you guys to like mentally make a note and say that there's probably sell side liquidity over here. And so if you ever had the feeling of being in a trade and price comes right for your stop loss and then turns around and goes the other direction, it's not because it's hunting you. And there's a lot of theories about this, like brokers can see your stops and they manipulate price. And sometimes in the forex world that's very true, but if you're trading like currency futures, everything is regulated. Everybody can see, like, there's one price. In forex, sometimes the brokers can offer a different price, and so they can manipulate things sometimes, or they can it's not unheard of some brokers to manipulate things, especially if they're not regulated. But when it comes to like future currency futures, everybody's seeing the same price. So the idea that the broker is hunting your stop is usually, it's not true. And we'll talk about the algorithm in a second. But the market knows that there's a lot of liquidity above these areas, and it will there's a lot of liquidity in the form of stop losses. There's also liquidity in the form of people trying to go short in these trades too. So I want you guys to notice over every single high, again, there's buy stops or buy stop losses or buy in orders above every high. And so what does the market do? It runs above this high, kind of wicks above it, right? And so if you had to imagine there being kind of like money here, right? It kind of runs up here, grabs the money, and then keeps going down. And you'll notice over time that old highs and old lows usually they either get wicked off of or completely ran through. So for instance here's an old low. And under this old low, like I talked about earlier, would be sell stops. So you might see me say SSL or sell side liquidity. And the market runs for those lows, right? And grabs that money. So just like there's money above old highs or stop losses, right? You might hear me refer to it as money. You might hear me refer to it as liquidity, whatever. It's just money in the market. There's money in the form of stop losses and pending orders above old highs and old lows. And the market will specifically target these levels to run to. Because again, the whole point of the market is to get people in the game, right? Brokers can't make money if people aren't taking trades or getting kicked in trades. The traders can't make money if they're not getting kicked into trades, right? So, or kicked out of trades, right? or getting kicked in or kicked out, both in the form of losses and wins. Um, so the market is going to consistently run to the areas in the chart where people have their money at. And that's why everybody has the feeling of, again, of being in a trade and price runs to your stop loss and you're like, oh, what the heck? And then it turns around and does exactly what you want to say because the market is being programmed to do that. So, shoot. I'm going to stop. One of these days, I'm going to stop doing that. All right. So, again, if you can see my chart, this is an example of this. This is my actual students go through this a lot too. It's usually because I keep like 2 tabs open on TradingView. So again, this is exactly what I'm trying to show you guys here. So again, over old highs is going to be buy side liquidity, right? And again, if you've ever had the feeling of the market running for your stop loss, right, under an old low, right, you're like, oh, it's going to be safe if it runs here, and then the market comes and takes you out, or above an old high. The market is designed to run for liquidity, right? It's designed to move between these areas over and over and over again. And so when you kind of take the blinders off and understand where the money is going to be at in the market, then you can start to predict where it's gonna go to. Again, over every high, there's going to be buy side liquidity, right? So I want everybody to kind of get in the habit of saying that under every low is going to be sell side liquidity. So notice how the market runs for old highs and old lows, right? This is an old high. Notice how the market runs right through it. On an uptrend, if you think about it, all you're doing is creating new highs that the market's going to continually run through. Right. And so get in the habit of saying, like, over every high, there's going to be buy side liquidity. And over every low, there's going to be sell side liquidity. And it's a really good exercise. And it's actually going to be homework for this week that I want everybody to go through their old charts and draw out old highs and old lows and see how the market runs for them again. There's a low sell side, and see how the market runs for that low, takes it out, right? And so over time, you can see how when you stop thinking about the idea of like supply and demand and kind of drawing zones out and start looking for these specific levels, you'll start to see the market will run for these things over and over and over again, because there's money sitting there. And so when we talk about the market, let me go to the comments. Yep. BISI. So BISI is going up towards buy side liquidity. Civi is going down towards sell side liquidity, 100%. So there's going to be liquidity in the BISI, right? It's going to be used to go higher and lower, but it's also going to be exactly running towards buy side liquidity or sell side liquidity, 100%. And so when we talk about kind of targets, and if you guys will start to notice this when I do my live chats, my live calls, I'm usually calling out an old high or an old low or a gap that I think price is going to run into for the week. And that's usually based on the idea that there's going to be money there that the market is trying to chase or trying to go after. So again, buy side liquidity, or anytime you see an old high, you need to think there's buy side liquidity or there's money above that high that the market might run to. Sell side liquidity, same thing. The last thing that I want to talk about with you guys today is, well, here was an example of the BISI since it didn't show the first time. Our Civi. This is going to be a Civi. So sell side imbalance, buy side inefficiency. And again, I drew these boxes to kind of illustrate the whole point of this, but the imbalance is too many sellers, not enough buyers. So think of these green boxes as kind of like paint pockets of buyers the market needs to come back up and get. Same thing with the BISI, right? I want you guys to think about this as the idea of too many buyers, not enough sellers. So we have these little paint pockets of sellers that the market needs to come back up and get. And you might be asking yourself, like, why is the market doing this? Right? Or like how does the market know that people are going to back into these zones? Well, it's just based on the same idea of that retail. Um, it's based on the idea that every trader has been taught, right? And it doesn't matter, like every trader kind of thinks this way, even though we don't all manually hit our executions like this. We all think of the idea that money to put our stop losses above old highs or old lows, depending on if we're trying to buy or short. And it doesn't matter if you're working for a hedge fund. It doesn't matter if you're your own trader. Like you're all like all traders do this. We all put our stops above old highs. We all put our stops below old lows. The real difference is we need to know when it's okay to do this and when it's not okay. Um, and so I will teach you guys that over the course of the mentorship. But the same ideas are the same. It doesn't matter if you're working at a hedge fund or if you're working at um, a your own personal trader for a desk. Um, so the question you might be asking yourself after kind of hearing this is, um, how does the market how like what causes the market to move up and down? Because again, the idea here is that um, the idea that we're taught as traders is that the market moves through this what's called buying and selling pressure, meaning that like if 10,000 people all hit buy in the market, then the price will just shoot up. And then if 10,000 people hit sell in the market, that the market will just shoot down, right? Like that's kind of like what you're taught. Like the idea of pressure means that like there's so many sellers and there's so many buyers stepping in on a trend. Like if you're in a selling market, then you see the market just shoot down. It's because sellers stepped in or there's selling pressure. Like I don't subscribe to that narrative because it doesn't really make a lot of sense. Um, the idea that market, like if just 10,000 people all hit sell at the same time or whatever, like it doesn't really make a lot of sense when you think about the idea that the market needs to have um every buyer needs to have a seller and every seller needs to have a buyer. So if I'm selling, so if I come into the trades, if I want to enter into a position like a short, right? And I'm sorry, if I want to enter into a position in a long, right? And I want to buy into a stock or a trade or whatever, someone has to sell me that. And so if the price is $10, right? When I enter in, like I say, I want to buy apples for $10. And let's say me and like 100 of my closest friends all agree to buy apples at $10 from somebody who's going to sell apples to us from $10. Price doesn't go up or down because we're all agreeing to buy in at that same price. So there has to be something else that's driving price up or down. Um, that causes it to move, right? Because again, you're coming in and you as a buyer are getting matched up with somebody who wants to sell that price or that stock or that apple or whatever to you at that certain price. Um, so how can buying and selling pressure exist when people are um, all agreeing to buy and sell at the exact price that they're seeing on the screen? That doesn't make any sense at all. So what I subscribe to is this idea called the algorithm. And it's kind of been a hot topic over the past, like, I don't know, maybe a couple of years in the market. But this has been something that I've been trading. The idea of this has been something I've been trading with in around for like the last 10 years. So like even before this whole thing has been really popular. And so this is going to be the last thing we're talking about today. It's more of a conceptual idea, but it's really designed to get your idea around the whole thing that this market is electronically delivered. It's an algorithm or it's a computer program that delivers price and causes things to move up and down. And so you might hear me refer to the algorithm a ton throughout all of this. You might have even heard about it on social, like you might see people talk about this. But the interbank price delivery algorithm, at a high level, which is very basic, um, the price that we the price that we see on the chart is delivered by an algorithm that's designed to match buyers and sellers. Buying and selling pressure does not control where the market goes. A million traders can hit buy on the chart or sell, and it won't make the market go up or down, vice versa. So, for context, um, if you've ever so trading's been around for like 100. The stock market, stock exchange has been around for over 100 years, right? Or close to 100 years at this point. Um, if you think about the old school like Wall Street stuff, like if you ever watch a video on Wall Street and there's been traders, like they're standing on like what's called the pit. So it'll be like a bunch of traders in a room and there'll be a bunch of screens or just people just yelling price like, hey, buy, 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 sell, sell, sell. Right. And so like in the before the 90s, what would happen is if Tony or if anybody wanted to buy a stock, right? What would happen is you would hear about a stock on the news, right? You would um, call your broker, right? You have to get on a call with your broker, or your broker will call you and let you know about the stock. But there has to be a phone call between you and your broker, and you would have to agree to buy, right, during market hours. Then what would happen is that broker would take that order, and they would call down to their guy in the pit, so the representative for the broker at the pit, and they say, so and so wants to buy 10,000 shares of Microsoft stock. Um, can we get him somebody that matches up with him that wants to sell? And so that guy at the pit would then call around or talk to somebody who is the liquidity provider or the market maker, right? That's down there on the floor and say, like, hey, I got somebody that wants to buy 10 shares of Microsoft. Do you have a seller? And so that person would then need to match that up with somebody who was at another broker who had 10 shares of Microsoft to sell, right? And so they would have this huge process just to have make that trade happen. And then they would have to get back to, that game of telephone would have to work its way in reverse all the way back to you to find out if you got, the share that you wanted, or you'd have to buy in at a certain price. And they would commonly agree, okay, cool, price is going to be here. And so that whole process could take like it could be as quick as 2 minutes or like a 2 minute call. It could have taken as long as like an hour or a couple hours or even like a day, right? And so it wasn't a very efficient price. And so what happened here is in the 90s, um, the market switched to what's known as electronic trading, or like ETF or ETH, electronic trading hours. And so what that did is, well, every time we hit buy or sell, that same process is happening, but it's just happening like this because um, a computer program or the algorithm is doing all that stuff very quickly, right? And so whenever something is electronically delivered, that means there's a code. That means when there's a code to it, that means codes are basically just series of patterns. And whenever those things happen, then it leaves little signatures in price, right? And so the whole point of the algorithm, the whole point of this thing is basically just that the market is going to run on three basic things. It's going to be time, price, and liquidity. And so what this algorithm does is it moves to and from areas of opposing liquidity with the whole intent of matching buyers and sellers, facilitating trade, and balancing order flow. So making sure that all these people with $1 trillion or $100 million in pending orders can get their levels hit, right? And so it moves price to that level, right? It kicks them in trades, kicks the people that need to get kicked out of the trades out, and then moves to the next area where there's enough liquidity. So basically, what I'm going to teach you guys throughout the next few weeks, months, etc. here is going to be, if we can understand how this algorithm works, how it works with time, how it works with price, how it works with liquidity, then we're going to be able to predict where the market's going to be able to move to enter and exit trades. We will not be 100%. We will never be 100%. But if you guys go back and look, if you're in my Telegram, if you're in the calls that I do every Saturday, then you guys can see with a high degree of accuracy me, who is a day trader from Michigan, can point out where the market's going to go, right? I don't have a degree in finance. I got an MBA. I'm not going to lie to you. I got an MBA, but I don't have a degree in finance. I don't have, uh, like, I've never worked on Wall Street, right? I definitely don't control any of these like huge billions of dollars worth that move the market, right? I'm just a trader who sees these patterns play out over and over and over again, and um, and can capitalize on them, right? So again, anytime there's a computer program, that means there's going to be a set of rules. If you learn the rules, then you can execute on these things. So that's going to be what we're going to talk about for the next few weeks, is really just how do we take these ideas of liquidity, how do we match them up with what the algorithm is going to do and how it's going to move price within these certain time windows, and then how do we formulate, how do we execute on those things. So it sounds really complicated. I'm going to do my best to break these down over very short, kind of like hour-long weekly sessions. It gives you enough to chew on them. You guys can come back and watch them over and over again. But again, last week we started with how the market moves. Today we're really kind of touching on why the market's moving, right? Why it's moving from areas of liquidity to liquidity. And then we'll talk about or I'm sorry, where the market moves. And then we're going to talk next week and then the next few weeks about how the market is going to actually give us opportunities to get into these things. So we're going to take the homework, basically for the homework today. All I want you guys to do is provide examples of those three things. This is for indices. Don't worry about this, but I want you guys to pick a Forex pair. It could be Euro USD, could be Euro futures, could be pound, right? It doesn't matter what it is, but I want you guys to do the following. Essentially, let me get out of this. Essentially, what I want you guys to do is go back and label all those things that I did today. So when you talk about, going to old highs, measuring out buy side, or writing like, okay, this is buy side liquidity. It could be this high, it could be a prominent high, or it could really be any high, right? And I want you guys to notice how these levels get hit over time, right? So if I zoom in, right? If I draw a fair value gap over time, how does the market come back into that zone and hit that? Same thing down here, same exact thing. There's another one right here. How does the market come back in and respect that level? If I draw an old high, right? How does the market come back in and respect that old high? Knowing that there's going to be money there in the form of stops, right? How do we hit that old high? And what do we do once we hit that high? Do we keep breaking through, or do we turn around? If we see gaps, right? We don't usually see a lot of gaps on the chart in Forex. There's one right there. This is what's called a volume imbalance, meaning there's a gap between these two candles, like an actual gap between where price closes and where it opens. So from that low to that high. I usually make my volume imbalances or my actual gaps black. I just label it like that. I have like visual representations and things in the chart, so I know when I'm looking at a zone, what exactly it is and what price should do when it gets there. So that's, again, a volume imbalance. See how price doesn't actually flow back into it. But I want you guys to go back into that and notice, again, how does the market react to these levels? How does it react to these zones? How is it heading towards those levels, right? That was a really good observation that someone put in the chat earlier about how fair value SIBIs form on the way to sell side liquidity, right? And that's usually the case. Here's a volume imbalance down here. This is Euro USD. So watching to see how these levels, what happens when price, forms that. And if you zoom in right here, that volume imbalance goes from that high of this candle to the open of this second candle. It's right there. And it came all the way back down pretty much filled that entire gap and then turned around and went the other direction. So I want you guys to go back in the charts, and that's the homework for this week is just go back and draw these old highs, draw these old lows, draw these fair value gaps, draw these actual gaps, and see what happens when the market runs back into them. Last example of volume imbalance, I'm going to show you that one right there and see how the price ran into that and didn't even go, respected that zone completely and did not close below it and then kept going higher. So you guys need to start to get used to seeing this on the charts. So I want you guys to delete, if you traded before, I want you to get rid of the idea of support and resistance and supply and demand, because a lot of times those ideas don't necessarily help us with building the idea of where the market should go, right? And or where it should go or why it should go. And so I think once you start to take apart like this whole like mystification or this, um, the mystery behind the markets, and you start to look at them like a machine, then you're going to start to see it's not, you're going to be less scared, right? Because then you're going to be able to start to build logic and reasoning as to why you should be in a trade, why the market should go there. And I think for me, I've traded I've traded a few different styles, right? I've had mentors that have had more support and resistance ideas with just market structure, right? Where they would draw out a zone and say like, uh, here's a wick, right? Oh, the wicks are supply and demand. Let me draw that zone out. Like you don't really have an idea of what the market should do or why it should run that way. And so when you're in trades, you're consistently scared. You're never really sure about what the market's going to do because you're scared because you don't really have a logic or reason as to why the market should keep moving in your chosen direction, right? And so with this idea, I'm going to help you guys get a narrative. I'm going to help you guys develop a bias. And so when you're in these trades, you start to expect things like, okay, well, the market broke. It took out this high up here and it didn't respect. So we should probably keep going lower. And so there are some crossover between support and resistance ideas and some of this stuff, but it gives you the idea of a narrative. And a narrative, having a narrative in trading makes you 10 times more comfortable. When you're in trades, it allows you to be comfortable enough to like raise the amount of liquidity that you're going to have or the amount of money that you're going to have on the line in the trade. And I just feel like it makes you more confident. And so that's crazy. All right. I don't know who this dog is, but get that comment out of here. Um, it's definitely programmed to make you think differently, but once you start seeing these things, you know it's working 100%. So next week, what we'll do is we will start to kind of combine what we talked about the first week with the sell side imbalances, the buy side, like all this stuff, the liquidity, and we're going to start to match that up with what we talked about over the past few weeks with time and the time windows and the different sessions, and we're going to see how the market really runs to certain levels in those given time windows. So hopefully this makes sense. If you guys have any questions at all, or if you feel like this doesn't kind of cover what you think it is, what you think that it should be covering, then let me know and we could talk about it, or just if you have questions. But again, the homework is to go through, pick a forex pair, and basically what I did, and look at, doesn't really matter what time frame it is, and start to draw some of these things out: buy side, sell side, fair value gaps, BISI, SIBI. I want you guys to label the BISIs and SIBIs, and then just make mental notes of what happens when price hits these levels. Um, so yeah, that's all I got for you guys. I'll stay on for any questions for a couple minutes, and then I'll just my camera will be off, but I'll stay on for a couple questions for a couple minutes. All right, guys. Have a good weekend or a good week, I guess, coming up. And you guys can definitely hit me in the chat for any questions. Like personally message me on Telegram. Seems like there's not a lot of people that come onto this, so it's gonna be probably more of a replay value, but feel free to message me in the actual Telegram personally. Like you can reach out to me with like a direct message or on social media. So hopefully you guys have a good weekend or a good week coming up and yeah, let's keep learning.